I'm John Hanna for CDTV.net in New York, and we have Greg Womack, the president of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good morning, Greg.
Good day, John. How are you?
Sounds like you're in great spirits. I'm okay,
Oh
and yourself?
man, we're pumped and primed and ready to go.
Okay. Where's the good spirits coming from?
Well, I think it's just after two solid weeks of volatility, I think hopefully we're ready for the markets to calm down. But who knows what this world's going to throw at us? We just
Right.
got to keep on our toes and have the best attitude we can.
That's it. That's a good thing. That's definitely a good thing to do. So, Greg, what do you have for us today at the Market Week report?
Well, the last week the equity markets managed to erase the previous week's losses, only to see those gains vanish once again over the rest of the week on discouraging economic news. So we saw, domestic equities decline the fourth straight week, and the small cap Russell 2000 has now corrected roughly 24% since July 7th. As you well know, an extended 20% decline is considered bear market territory. So the Russell 2000 small cap is down much more than the other indexes. Year to date, the Dow was finished off last week around 6.5%, the Nasdaq 11.7%, the S&P around 10.7%, the Russell 2000 roughly 17% down for the year. Global markets also suffered. The German DAX lost almost 10% for the week, partly because of the figures that showed, the stalling economic growth there. But Treasuries once again benefited from all the anxiety. Yields plummeted to really record lows on the 10-year Treasury that I've seen in decades, and just near historical lows. And the 30-year plummeted more than 30 basis points. And so gold shot up, yet another new record, ending around $18.50 an ounce. Now, John, as I'm speaking, as around noon Eastern time on this great day of August 21st, 2011, 22nd, August 22nd, we have a Dow is up 55 points, Nasdaq up 7 points, the S&P up roughly 3.5 points, and gold up, hitting a new record, up 35 points. All these were trading higher earlier in the morning, but have since tapered off some. As we kind of dig into last week's headlines, John, we look at some of the economic news here locally in America. They had the nation's industrial output rose about 0.9% in July, according to the Federal Reserve. We also had estimates for May and June revised upwards. So roughly about 77.5% of the nation's industrial capacity was in use, which is about 2.2% more than last July. However, the flip side of that coin is the Federal Reserve survey of Philadelphia region manufacturers during the second week in August showed a 34-point drop. It was a negative 30.7 reading, and this is the survey's lowest level since March 2009, though many of the firms said they expect growth over the next 6 months. Now, you'll remember that March 2009 was not a very pretty, happy time around the economy and the markets, kind of the low point. So we're kind of dipping down as far as the manufacturing. Consumer prices rose about 0.5% in July, keeping the consumer inflation rate for the past year at 3.6%. Rebounding gas prices really accounted for over half the increase. According to the Bureau of Labor Statistics, higher food prices, especially dairy and fruit, were important in those figures. And inflation at the wholesale level rose 0.2% in July. But if you take out food and energy, the figure was 0.4%, marking the 8th straight monthly increase. So we're getting continued inflationary pressures. If we go overseas, the French president Sarkozy and the German Chancellor Merkel agreed to establish a council to oversee economic issues affecting the Eurozone. They proposed a tax on all financial transactions and a requirement that all member countries agree to balance their budgets by next summer. And meanwhile, the second quarter growth in both Germany and France was essentially flat. This was raising some concerns about their ongoing role as the linchpins of the EU economy. Back home, housing starts slipped 1.5% in July, according to the Commerce Department. However, starts of multifamily buildings rose 6.3% from June and were up 66.7% from a year ago. So single-family home starts were higher in July, but the existing sales of existing homes fell 3.5%. So we still have a lot of weakness in the residential markets, although apartments and multifamily buildings are experiencing a nice growth trend. And let's talk about ratings. Fitch reaffirmed its AAA rating for U.S. debt. However, the ratings agency said that it could change if economic recovery is weaker than expected, or if the committee charged with tackling this decision fails to reach an agreement. Speaking of ratings, the Standard & Poor's is reportedly under investigation by the Justice Department for allegedly improperly rating mortgage-backed securities prior to the 2008 financial crisis. So what we're seeing is these rating agencies starting to shape up how they're going about rating even the U.S. government debt because of the past sins and overlookings perhaps. If we look ahead, I think a lot of the eyes will be on the Chairman Ben Bernanke's speech Friday at this year's Economic Symposium in Jackson Hole, Wyoming. At last year's meeting, he signaled the possibility of a QE2. That's a quantitative easing, number 2. So there's speculation that there may be hints of a QE3 possibility. So all ears and eyes will be there. And also, if the initial estimate of the 1.3% growth in domestic product is substantially revised on Friday, estimates of the potential for a renewed recession could be affected. So that will be watched closely as well on Friday. So key dates and data this week: new home sales on the 23rd, durable good orders on the 24th, and of course the second estimate of second quarter gross domestic product on the 26th. Should be an interesting week, John. School's back and traders are back, and we'll see how this week shapes up and see if we can reduce the volatility in the markets, or do we still have angst around the corner.
Okay, now I got a question for you. Well, let's talk about the European issue with France and Germany. Are they taking the lead now with regards to trying to organize the situation in the Eurozone?
Yeah, pretty much. I mean, it appears that they declined the support of a concept of a Eurozone-backed bond, collected by the European Union at this point. So it looks like that they are, trying to coordinate and take charge of those issues going over in the Eurozone.
Now, if it doesn't go their way, what do you think are their next move now? Are they going to separate from the Eurozone, or are they going to have their own separate economy between the two countries?
Well, that's a big question, and they've kind of dug themselves into a hole by supporting and backing some of the the bailouts that have taken place so far. So it's hard to say exactly how it's all going to shake out, because it is a big mess, lots of stuff to unwind. But at this point, I don't see them separating themselves at this point.
Okay, and the QE possibilities with the upcoming meeting or presentation. What do you think is going to happen there? I mean, we currently have a low interest for like the next 2 years, right? And how is that going to pan out with an additional QE, quantitative easing?
Here again, very complicated and hard to say exactly what will happen. although interest rates remaining low, I don't anticipate him to probably make any major announcements soon, but the economy is showing signs of weakness. And of course, the pressure will be on from the White House, with elections coming up and trying to get this economy turned around. So, we could either see some either bond buying announcements down the road, definitely some stimulus as far as from the White House as far as tax cuts for businesses and employers. So it's hard to say what will come out, but I think you'll start to see that happening, especially as we see the economy starting to weaken, or at least showing signs of weakness.
And I've always asked this with some of the guests that we've had here, and you're an investment advisor. Do you have some dry powder now, or what are you doing now? Are you buying? Are you just holding firm with what you have?
We've been pretty much hold, and we've raised some funds, and in areas where we've had some gains, so we not give up more gains. We've been long in gold, metals, and silver, and the miners, and those are doing quite well. And even as we speak today, a lot of the mining companies have underperformed over the last few months, the gold futures, but now are starting to break out on the upside because gold has trended up so much. I do believe we'll see a pullback in gold at some point. We've just seen such a nice increase over the last month or so, and that's normal and will be healthy. I would look for that as a buying opportunity because the uncertainties in the world are still at large, and we will, I think, continue to see gold in the long-term uptrend. We've been long gold, John, since 2005 and 6 range, where we started really allocating heavilier into at least 10% of our clients' funds into gold.
Well, what was it?
Go ahead. Pardon? I would like to take some profits probably, because we've made a lot of money in those areas, take a little bit of profits, and then we'll probably go back at it if we see a nice pullback.
I was going to ask you, do you remember the price in 2005 for gold? Because it seems like a distant memory now.
I don't. I know that I've been, personally been in gold for some time, before that even, but as far as allocating among our clients' individual accounts, it was probably in the $600-700 range, back then. We've seen such a nice increase in gold and silver too, for that matter. We've been in silver for quite some time, ever since the silver fund, silver exchange traded fund, has been out, which my charts show we were in it first back in 2006. Around middle of June 2006, when it came out. It was going for around $12 a share, and now it's upwards of $41, $42 a share. And I think silver, it's not increased in the last few months as much as gold, and there's probably, gold could see a slight pullback, which would be healthy for it. Silver, on the other hand, is just building a good long base and probably could have more upward momentum.
All right. Any closing statements on the market climate?
I just think and we've also shorted some of the market in the last few weeks. I just think on the S&P, we have a critical technical level here, and that is if we can hold above that 11,000 level, we have a chance of building a base here and possibly making a run at the previous highs, or at least the 1,300 range on the S&P. It's currently trading for 1128 as we speak, but the 11,000 is kind of the support level. We've got to hold that. We've got to hold that ground, or we could see another down leg.
That's Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma. And I'm John Hanna for CityTV.net in New York.